In a Bermuda-registered ledger, two telecommunications carriers agreed to buy nearly identical amounts of dark fiber capacity from each other on the same day for nearly identical sums. Roughly $100 million flowed one direction on paper. Roughly $100 million flowed back. No cash of consequence changed hands. No customer had asked for the bandwidth. One half of that paper became revenue, recognized immediately and reported to shareholders. The other half became a long-lived capital asset, parked on the balance sheet, its cost bled out over as much as 25 years. The SEC enforcement records settled that the swaps were improper. The structural question remains: how does a transaction in which two companies exchange the same thing for the same price produce reported growth for both? That asymmetry is the mechanism. The instrument at the center of this case is the indefeasible right of use, the IRU, a long-term, essentially irrevocable lease of a defined amount of capacity on a fiber optic cable or of the fiber itself for a fixed term. The word indefeasible signals that the buyer's right cannot be revoked by the seller for the agreement's duration. It functions like ownership of a strand of glass without transfer of the physical cable. IRUs were a legitimate feature of how global fiber networks were financed. Building a transoceanic cable costs hundreds of millions of dollars, and no single carrier needed all the capacity it built. Carriers sold long-term rights to portions of their networks and bought rights in regions where they had no cable. A carrier strong in the Atlantic might sell Atlantic capacity and buy Pacific capacity, assembling a global footprint without laying every mile. Under the standards then in force, the seller of an IRU could, if the transaction met certain conditions, recognize the sale as completed and book the proceeds as revenue. The buyer had acquired a capital asset, a right of use spanning decades, capitalized on the balance sheet and amortized across its useful life. The seller books revenue now. The buyer books an asset and expenses it later, over many years. In an arm's-length sale, one party genuinely wants capacity, pays cash it would otherwise keep, and takes on an asset it needs. A real economic exchange occurred. The distortion begins when the transaction is reciprocal and simultaneous. Suppose carrier A sells $100 million of capacity to carrier B, and on the same day, in a matching agreement, carrier B sells $100 million of capacity to carrier A. Each company is now seller in one contract and buyer in the other. As the seller, carrier A recognizes $100 million in revenue immediately. As the buyer, carrier A capitalizes the $100 million it paid and expenses it slowly over 20 or 25 years. In the current quarter, carrier A reports a full $100 million in new revenue against only a small fraction of the cost. The same is true, mirror image, for carrier B, both booked revenue. Neither parted with meaningful cash. The payments cancel. In economic substance, a wash. In accounting form, growth. The industry called this a capacity swap. When structured to inflate reported revenue rather than meet a genuine network need, it became what regulators called round-tripping. Value sent out one door and received back through another, generating a reported result without economic substance. The fraudulent version required only that the paperwork match. Global Crossing was, at its peak, one of the most aggressively capitalized telecommunications ventures of the late 1990s. Incorporated in Bermuda, it raised enormous sums in debt and equity on the promise of a global fiber optic network, undersea cables and terrestrial routes, that would carry the world's exploding internet traffic. Its valuation depended on demonstrating that demand for capacity was real and growing. One metric mattered above almost all others: recurring revenue from the capacity sales and a related cash flow measure, the company reported. In a capital-intensive, heavily indebted business, growth in reported capacity sales was the signal the investment was paying off. Place the capacity swap into that pressure. Step 1. Global Crossing identifies another carrier, often one under similar pressure, to show growth. The two enter paired agreements. Global Crossing sells a defined quantum of capacity to the counterparty. The counterparty sells a closely matching quantum back. Step 2. The dollar values are set approximately equal, figures ranging from tens to over $100 million per pairing. The near equality is the design. It keeps the cash effect neutral, while the accounting effect is maximally favorable. Step 3. The two agreements are executed in the same period, often the same day, so revenue lands inside the quarter the company wants to strengthen. Step 4. The accounting split. On the sell leg, Global Crossing recognizes the full contract value as a capacity sale. On the buy leg, it capitalizes the purchase as a fiber optic asset or prepaid capacity right, amortizing the cost over as much as 25 years. A $100 million sale recognized in full adds $100 million to revenue. The matching $100 million purchase, amortized over 20 years, adds only about $1.25 million to expense that quarter. More than $98 million of offsetting cost is deferred. Step 5. Repeat. The structure is scalable. Each swap adds to current revenue while deferring the matching cost across decades. A company under pressure to show accelerating growth could manufacture it by increasing the volume and size of reciprocal swaps. The SEC examined Global Crossing's use of these reciprocal transactions. The central concern was disclosure. Investors were not adequately told how much reported capacity revenue derived from reciprocal swaps, as opposed to genuine sales to end users who needed bandwidth and paid cash. $1 of revenue from a customer carrying actual traffic is recurring, reflects real demand, and is backed by incoming cash. $1 from a reciprocal swap reflects no net demand and produces no net cash. The $2 looked identical on the top line, and substance was exactly what an investor needed to distinguish them. The broader sector saw multiple companies engaging in reciprocal capacity transactions, drawing regulatory and prosecutorial attention across several firms. Global Crossing's arrangements sat at the intersection of aggressive growth targets and an accounting treatment permitting immediate revenue recognition on one leg while deferring the cost of the other. A transaction this structurally visible, two companies buying the same thing from each other on the same day, raises an obvious problem. How did it survive the gatekeepers? Begin with the auditors. For a substantial period, immediate recognition of revenue on the sale leg was defensible under the standards then in force, provided the transaction met the criteria for a completed sale and amounts were at fair value. The IRU sale, on its own, looked like a legitimate sale of a right of use. The purchase, on its own, looked like a legitimate acquisition of a capital asset. The impropriety lived in the relationship between them, the reciprocity, the simultaneity, the near equality of value, the absence of genuine need. To catch that, a reviewer had to connect the two contracts and ask whether, together, they represented a real exchange or a circular arrangement engineered to produce revenue. There is a principle for exactly this. A transaction must be evaluated by its economic substance rather than legal form. When a company exchanges an asset for a similar asset, the exchange may lack commercial substance, making recognition of revenue or gain inappropriate. If two carriers swap interchangeable capacity of equal value, substance over form asks whether any real earnings event occurred at all. But if the two legs were papered as separate agreements with separately negotiated terms, capacity in different geographies, and independently supported valuations, the argument that they were dissimilar assets exchanged at fair value became available. The separateness of the paperwork was not decorative. It was load-bearing for the accounting conclusion. Now the analysts. They tracked reported revenue and cash flow metrics closely, but worked from disclosed figures. If disclosures did not break out how much revenue came from reciprocal swaps versus end users, an analyst had limited means to strip the swap revenue out. The detection failure was downstream of the disclosure failure. There is a tool that would have exposed the pattern. Reconciliation of reported revenue to cash. Round-tripped revenue grows the income statement without producing corresponding operating cash. An analyst rigorously reconciling reported capacity revenue against cash collected would have found a growing wedge. Revenue climbing while cash failed to follow. But that reconciliation needed the disaggregated data the SEC's review put at issue. A fraud built from individually defensible components is far harder to detect than one built from a single, obviously improper act. The capacity swap was two truthful-looking halves whose combination told an untruth. The verification chain was organized to examine halves. When many companies in an industry face the same pressure and the same accounting opportunity, the practice becomes widespread. And a widespread practice acquires camouflage. Normalization across multiple carriers reduced the signal any single company's swaps would otherwise have sent. So, the machine ran. Revenue climbed. Cash did not fully follow. Disclosures did not explain the difference. Then the environment changed. The reciprocal swap structure depended on a continuous supply of counterparties willing to enter matching transactions, but the economics were hollow. Revenue without cash. And Global Crossing carried an enormous debt burden raised to build the network. Debt requires cash to service. Revenue that arrives without cash cannot service debt. When the telecommunications capital cycle turned, and the anticipated demand did not arrive on the priced-in timeline, the market value of fiber capacity fell. Carriers held capitalized capacity assets, whose balance sheet value increasingly exceeded any realistic market value. And the swap revenue could not be repeated indefinitely, because counterparties were running out of cash and appetite. Global Crossing filed for bankruptcy protection in early 2002, among the largest bankruptcies in United States corporate history to that point. Driven by the debt load against a business whose real cash-generating capacity had never matched its reported revenue trajectory. The bankruptcy triggered scrutiny from the SEC and Congress. The SEC's enforcement conclusion centered on disclosure. The company had not adequately informed investors about the nature and magnitude of its reciprocal capacity transactions and their effect on reported results. The enforcement theory did not need to establish that immediate revenue recognition was categorically forbidden, only that the company had a duty to tell investors how much reported capacity revenue came from reciprocal swaps, and that this duty was not adequately met. The swaps did not collapse because a gatekeeper caught the reciprocity in real time. They collapsed because the underlying business could not generate the cash the reported revenue implied. On the way up, the asymmetry between immediate revenue and deferred cost produced the appearance of growth. On the way down, the absence of the cash the revenue had never carried left the company unable to meet obligations that were entirely real. Several companies faced regulatory and prosecutorial attention over similar practices. The clustering confirms the vulnerability was a structural feature of the accounting treatment combined with growth pressure, not isolated misconduct. When a rule permits one leg of a symmetric transaction to be recognized as revenue while the offsetting leg is deferred over decades, and an industry is under uniform pressure to show growth, the round trip becomes a predictable strategy. The company that emerged from bankruptcy was reorganized and much reduced. Investors who priced the securities on reported revenue growth bore the loss. What does the case establish as a finding? First, the danger in a capacity swap resides not in either leg, but in the asymmetry of accounting treatment applied to a symmetric economic exchange. When two parties trade equal value in opposite directions, and one direction is recognized immediately as revenue while the other is deferred over decades, the transaction generates reported growth without economic substance. The larger the swap and the longer the amortization, the greater the divergence. Second, a fraud assembled from individually defensible components is structurally resistant to detection. A swap presented as two separate transactions could pass through intact. The principle that would have caught it, evaluate substance over form, test exchanges of similar assets for commercial substance, required a reviewer to first collapse the two legs into one. Third, revenue to cash reconciliation is the structural counter to round tripping. Any framework rigorously testing reported revenue against cash collected will surface the wedge. The detection failure was, at root, a failure to give investors the disaggregated data needed to run that test. The regulatory consequence followed. Standard setters and regulators sharpened the treatment of non-monetary exchanges of similar assets, tightening the conditions under which revenue or gain could be recognized when they lacked commercial substance. The broader post-2002 reforms strengthened the framework within which such transactions are audited and disclosed. Two companies bought the same thing from each other on the same day for the same price. The transaction was economically a wash. Through the asymmetry of recognizing the sale now and deferring the purchase over decades, both reported it as growth. The mechanism required no cash and no customer, only that the paperwork match and that no one downstream collapse the two halves back into the single circle they always were.